I want to welcome everybody to our State of the Markets presentation. We're happy to have you here today. And once again, we're going to be sharing some important information with you. You who've already been on this many times were required to do these disclosures, so I'll leave them for a couple of more seconds and we can move on. So we're going to focus on four key questions today. One, how did stocks perform in 2023? What drove that market performance? Where are we now? And what are the major forecasts? And I mixed in today's meeting a couple other slides that I think will help resolve some issues around kind of what's happening in the major indices and in the markets. So let's begin with a look back at Wall Street initial predictions for the stock market in 2023, how those stocks actually performed in 2023, and some of the factors that drove that performance. The S&P 500 closed at 4,769 at the end of 2023, a gain of 24.33%, and well above the most optimistic expectations of the major Wall Street analysts. In fact, as we can see, forecasts fell well short of how stocks performed. There may be several reasons for this. The first reason was that many observers and economists expected a recession in the first half of 2023. It never came. They saw higher interest rates and bond yields as depressing stock returns. Also expected by most experts and investors alike was that swell of AI or artificial intelligence enthusiasm. Few imagined the progress, widening interest and implementation of AI. As AI developments unfolded, they sparked a powerful lift in technology companies, which buoyed the rest of the stock market. Stocks also benefited from falling yields as inflation decelerated faster than many had anticipated, leading to hopes of a Fed easing. Despite periodic worries over the health of the regional banks and episodic worries that the Fed may remain restrictive for longer than hoped for, stocks moved higher, closing strongly, really strongly actually, in the final 2 months of 2023. Remember, the S&P 500 composite index is an unmanaged, generally considered representative of the U.S. stock market. An index performance is not indicative of past performance of any one particular investment. So let's take a look now at the market performance and what factors that affected the stock market over the last year. After a disappointing 2022, stocks moved higher to start the year and continued higher the remainder of the year outside of a few notable retreats. I want to draw your attention to the plot points on the graph because they highlight the key storylines that drove the stock market in 2023. They came down to two broad themes: the track of inflation and the Fed. And as you can see, the early part of the year, the Fed is still hiking rates in the face of still too high inflation. Nevertheless, the market is moving higher, perhaps for two reasons: bargain hunting and anticipating inflation will moderate and the Fed will eventually stop its rate hikes. As we look at the data points in the later year, sure enough, inflation is coming down and the Fed is now pausing on further hikes, so much so that by the December FOMC meeting, the Fed is signaling rate cuts for 2024. Of course, markets never move in a straight line. There were some hiccups in this advance. One was the so-called regional banking crisis in March and some backtracking on inflation progress in September and October. A relatively strong economy and a jump in inflation caused some concerns in the fall that the Fed may not have room to ease, which is why we saw bond yields peaking in October. However, as inflation resumed its decline, by December, the Fed was comfortable signaling to the markets that rate cuts may be in the offing in 2024. Finally, keep in mind that amid falling inflation, labor markets remained robust and the economy was reasonably healthy, which raised hopes for a soft landing. I've included this slide. This is another slide, and the reason why I included it is because this is actually the MSCI All Country World Index. And you can see a similar pattern to what we saw in the S&P 500. And on there, you can see some of the key events that were raised in the other slide about the Fed raising rates and credit rating and some other geopolitical events. But what's interesting about it is despite all these events and concerns that popped up throughout the year, the disciplined investor who stayed invested actually, had a pretty decent return for the year, despite all the ebbing and flowing of the markets. This is another global market view. This is global equity markets. You can see on the left-hand side, the global equity market, as measured by the MSCI, was up 21.58%. The contributing factors were U.S. equity, as measured by the Russell 3000 index, up 25.96%, which represented 61% of that global return. And then the ex-US and the developed world, mainly Europe and Japan, was up 17.18%, and that was 27.8% of the return. And then the emerging markets finished in third. So that's the composite of the global return. And the reason why I point this out is because, most of our portfolios do have somewhat of a global exposure. And so it's important to understand not just U.S. equity returns as measured by the S&P 500, but also the returns of other indices outside of the U.S. And on the right-hand side, that's global fixed income. Global fixed income, as measured by the Bloomberg Global Aggregate Bond Index, was up 7.15%. And you can see there that was largely driven, or at least 60% driven, by ex-US, non-US bonds. And so even when it comes to your fixed income part of your portfolio, it's important to understand where these returns are coming from. And finally, sector returns. You heard me mention earlier about, AI and tech getting a little bit hyped up. Well, you can see here from this graph that information technology, this is globally, right? Not just the US, really powered these returns over the years. And so tech was out of favor as interest rates were going up in 2022. Tech got clobbered. Value is definitely the way to go for 2022. But we see now in 2023, it made a big comeback, in part driven by AI, but also consumer discretionary and some other industrials and things like that. So you can see where these returns actually landed on a global basis. S&P quarterly earnings. Corporate earnings are one of the factors that drive stock prices over the long term. As the chart shows, the earnings growth for the S&P 500 companies appears to be emerging from what market watchers call an earnings recession, which you can see right in here. So that is when there's at least 2 straight quarters of negative earnings growth. As you can see, corporate profit growth decelerated in the 3 quarters preceding the most recent quarter of reporting, which was the third quarter of 2022. Or excuse me, 2023. Overall, companies struggled in recent quarters due to rising prices and global economic slowdown. But by Q3, the Q3 was more encouraging as companies recorded positive profit growth for the first time since the third quarter of 2022, aided in large part by revived consumer spending. While the third quarter growth was welcome, it was driven by just a few sectors of the economy. This narrow contributions to earnings growth is concerning and leaves some investors worrying about the durability of earnings growth in the year ahead. We already touched upon some of the economic numbers, but let's spend a little time getting a broader view of the economy in 2023. This year, the word used by Wall Street and economists alike was resilient. They remarked on our resilient comment, a resilient labor market, and the resilient consumer. As this table illustrates, the description is an apt one. With fresh interest rate hikes throughout the first half of 2023, on top of unprecedented rate hikes in 2022, many felt that these so-called demand destruction efforts by the Fed to lower inflation would do just that, reduce consumer and business demand by making purchases and capital investment more expensive. While such rate hikes can take a while to work themselves through the economy and whose lag effects may yet still be felt, the actual experience was that the economy grew at a respectable rate and is slated to expand nicely in the fourth quarter. And the labor market was strong beyond many experts' ability to explain it. All the while, inflation maintained its downward trend from its height in 2022. The economy in 2023, however, had its issues. Consumer sentiment remained low and stagnant. Though this seems paradoxical amid healthy economic growth and strong employment, consumers have been especially concerned about the high cost of goods and services. Many experts forget that the sharp run-up in prices of 2022 hasn't come down, even if today's inflation rate has. The reality is that despite disinflation, prices today are much higher than they were pre-pandemic, which has soured the mood of many Americans, especially those who are at least able to bear the financial burden of higher prices. We also see pessimism in the housing market as reflected in the sentiment index of home builders. High mortgage rates and climbing home prices have left builders and prospective homeowners discouraged about the affordability of buying a new home. So where are we now? We've looked at some factors affecting market performance in 2023. Now let's look at where we are now and examine the headwinds and tailwinds that could affect the direction of economic growth and financial markets in 2024. To create some context around where the economy stands now, let's examine where we stood in 2020. I picked this as a reference point since it represents a moment in which the nation was finally emerging from the pandemic, though not completely out of it, and Americans went to the polls to vote in national elections. As the indicators suggest, the outlook for the next 3 to 6 months was mixed. The Federal Reserve's monetary policy was still accommodative and interest rates sat at historical lows. Nevertheless, the economy appeared weak, hurt by consumer sentiment and the labor market. I want to draw your attention to inflation in the bottom left-hand corner. It still looked unthreatening at the time. Now let's look at the end of 2022 when many economists and market watchers predicted a recession in 2023. As the indicator suggests, there was good reasons to worry about a recession. As we can see, no economic or financial indicator suggested a strong economy or stock market. Important measures like consumer spending, corporate profits, and inflation were neutral, while monetary policy, housing, interest rates, and leading economic indexes were all flashing red. Fortunately, the economy and the stock market were a bit more resilient, to use that word again, than many imagined. Despite the gloom entering 2023, the economy and stock market would defy expectations, a reminder that investors should pause before adjusting their long-term investment plans. Now let's take a look at January 2024. As the indicator suggests, caution may be a good word to describe the economy as we enter the new year. Consumer spending, corporate profits, inflation, monetary policy, housing, mortgages, interest rates, and the leading economic indicators are all neutral. Additionally, the geopolitical risk and international economic categories are red. And it seems that despite the stock market's end of the year rally, nearly all financial indicators remain neutral as we enter a presidential election year. Let's examine one of those speedometers more closely, the leading economic index, or the LEI. This index includes 10 components ranging from stock prices to manufacturing orders. This data may give a clearer view of where we are when examined together. As this chart shows, the outlook trended lower throughout 2022 and 2023, though it appears to have bottomed out at the close of 2023. The LEI has been accurate in anticipating 3 recessions since the year 2000. However, it appeared to signal a recession in 2023 correctly, or rather incorrectly. In fact, GDP growth rose even as the LEI was painting a weaker economic picture. So while no economic indicator is ever 100% perfect in predicting economic futures, the LEI remains an important input into developing our views about the economy in the coming months. Remembering that past performance may not lead to future direction is important. But as we view charts like these, history can help suggest where we are in the economic cycle. It's also important to remember that forecasts are based on assumptions and subject to revisions over time. From the leading economic indicators and the economic speedometers we just reviewed, it's clear that uncertainty is the watchword for the economy in 2024. The outcomes range is quite wide, and as economic performance may turn on a few key variables. The first potential headwind facing the markets is inflation. While inflation has come down from its post-pandemic highs, it has remained persistently above the Fed's 2% inflation target. It may handcuff the Fed a bit if inflation remains stuck in the 3 to 4% range. However, at its final meeting in 2023, the Fed said it anticipates 3 rate cuts in 2024. That leaves our next potential market headwind, recession. The much feared recession did not materialize in 2023, but recessions are a natural and inevitable part of the economic cycle. While a case may be made for avoiding a recession this year, there are plenty of reasons that a recession may emerge. Among them are resilience of consumer spending, continued global economic weakness, especially in China, and the surfacing of the delayed impact of the steep rise in interest rates over the last 2 years. Corporate earnings may be a headwind. If stock prices are to move higher, they need to improve from recent levels. We earlier showed how third quarter earnings have hinted at this recovery. The market's current valuation level may have already priced in this recovery, and should the expected growth in earnings fail to materialize, it will be difficult for stocks to rise from these levels. Geopolitical tensions are always a wild card for markets as well. First, it was the unanticipated invasion of Ukraine in 2022. Then it was in the conflict in Israel in 2023. Looking ahead, we see a stalemate in Ukraine, ebbing Western support, and uncertainty as to what follows in the Gaza Strip. And of course, China's muscle flexing in the Pacific region remains worrying. Finally, the stock market now has the competition for investor dollars. With bond yields at levels not seen in decades, many investors may find that they can obtain reasonable returns at less risk, leading to fewer dollars to support higher stock prices. While the headwinds facing stocks are uncertain, they are not to be underestimated. There are several potential tailwinds that may support the financial markets in 2024. One reason for the rally in the fourth quarter of 2023 was continued deceleration in inflation. If inflation maintains its downward trend, it will be positive for stocks, since it may help increase corporate profits and allow the Fed to move ahead with rate cuts in 2024. The caveat here is that the Fed has said it will need to stay committed to the inflation fight. Another potential tailwind is the prospect of China returning to strong economic growth, which can have broad benefits for the global economy. China's economy has been struggling under the weight of a late lifting of COVID-related restrictions, among other factors. Nevertheless, they remain a dynamic economy that may only be a government intervention away from recovery. Finally, there's the start of a new economic revolution akin to electricity and computers. Of course, I'm referring to artificial intelligence. The emergence of AI was a big story in 2023 and a major catalyst for the market. Much of the excitement was based on the future potential. This year may begin seeing the initial real-world impact to businesses as AI potentially turns into a new and substantial revenue stream for the AI ecosystem of providers, from chip makers and software companies to cloud providers through which these AI models operate. Perhaps more importantly, we may also see non-technology companies begin wider implementation of AI in marketing, sales, operations, and administrative functions to drive growth, productivity, and higher profits. Before discussing the 2024 forecast, let's examine this chart to see where stock prices trend against historical averages. The most common way to do this is to look at the PE, or the price earnings ratio, which measures investors' willingness to pay for a company's earnings. Looking at the dotted line in the middle, you can see that the PE for the last 25 years is, on average, 16.76. You can also see that the PE moves quite a bit, with a peak near 1999 and a trough in 2008, right? Peak, trough. The chart shows that the PE was 17.83 on September 30th, 2023. Does that mean stock prices will head lower or climb in the months ahead? Now, that's really difficult to answer, but it's fair to say that past performance that we're looking here in this chart is not really a guarantee of future results. It's just a way for us to look at relative valuations over time. And the return and principal value of stocks will indeed fluctuate as market conditions change. We've talked about what impacted markets over 2023 and what may impact markets in 2024. Now let's see what the financial professionals have to say about where they think the market is headed in the context of a more detailed discussion of some of the possible headwinds and tailwinds we just finished reviewing. Before discussing Wall Street analyst predictions, let's examine some important inputs that may impact the stock market's direction in the coming year. As many of you know, corporate earnings may be a key driver of stock market performance in 2024. According to FactSet, a leading financial data and analytics firm, earnings are expected to trend higher in 2024, plateauing by the fourth quarter. As you can see here, this is that trending higher. While this is a good sign, it's also difficult to say how much of that earnings growth expectation has already priced into stocks, especially in light of their current valuation level. Estimating quarterly earnings is difficult, to say the least, but such estimates can help guide decisions about what price they pay for a stock. If earnings are healthy, it may support higher prices. Conversely, should earnings come in short of expectations, it may put downward pressure on stock prices. It's important to remember that these forecasts that we're looking at are all based on assumptions subject to revision without notice and may not materialize. And if we've learned anything during the past couple of years, the outlook for financial markets can change quite quickly. The course of stock prices in 2024 may be correlated to the Fed's decisions about interest rates. One tool traders look to understand where rates may be heading is the CME FedWatch tool, which analyzes the probabilities of future target rates as implied by the 30-day Fed funds futures pricing data. If we look at where the market thinks the Fed is going, we see that the market believes there is almost a 42.5% probability of the federal funds rate falling by 50 basis points, or that's a half percentage point, right? Or by the end of June. In early December 2023, the Fed funds rate was 5.25% to 5.5%. Traders also priced a nearly 20% probability for a 75 basis point decrease within the first 6 months of 2024, while there's a 30% likelihood of just a 0.25% cut. There is only a 7% chance that rates will remain unchanged by mid-year. The market's optimism has often raced ahead of the Fed's intentions, so investors should be cautious. However, if these cuts come to fruition, it may have a positive implication for stocks. Economic forecasters surveyed by the Philadelphia Fed in the fourth quarter updated their outlook for Q4 2023 and all of 2024. They slightly increased their expectations for Q4 GDP growth to 1.3% from 1.2%. In 2024, they anticipated positive growth each quarter, so at this point, no recession appears in the forecast. Interestingly, their unemployment rate projections stay flat throughout the first half of 2024 with a slight uptick towards year end. It will be interesting to see how or if economic growth influences the unemployment rate. I've said this before, but it's important to remember that forecasts are based on assumptions and subject to revisions. And especially when we're talking, they'll revise GDP 2 quarters back, right? And unemployment 2 or 3 quarters back. So the initial reading is almost always subject to change. So that's something that we have to keep in mind when we're looking at these forecasts. Aside from interest rates and inflation, one of the most critical factors that may decide how the economy and the stock market do in the new year is the health of the consumer. Consumer spending represents about 2/3 of the American economy, and if consumers pull in their spending in 2024, it could have consequences for the market. Consumer spending trended higher following the pandemic, first on goods, as Americans spent time sheltered in their homes buying stuff, and then on services like travel, once the COVID restrictions were lifted and they felt comfortable leaving their homes. This bulge in spending was lifted by what economists called excess savings. In other words, the amount of savings over the level that would have likely been reached without the pandemic. The primary sources of those excess savings were, 1, not spending on things like commuting to work, clothes, and dining out, and 2, the government transfer payments called stimulus checks or stimmy checks, if you've heard the slang. As we can see from the chart on the left, the amount of excess savings has declined with time, leading some economists to wonder if consumers can maintain their pace of spending. Now, if we look on the chart on the right-hand side, we see consumers' debt levels from auto loans to credit cards. Credit card balances often get the most attention in financial news, but all 5 categories are important to watch. With the combination of shrinking savings and changes in household debt influence consumer spending habits. That's difficult to answer, but consumers can surprise the experts. One key positive is that Americans are broadly employed, and for now, they can find work if they need to. So what are the major financial firms forecasting for domestic stock prices in 2024? As they did for 2023, analysts painted a mixed year for stocks as the average forecast sits about where stocks ended in 2023. That's like the second year in a row where we've had that. You'll notice significant divergence in these forecasts running from a low of 4,200 to a high of 5,100. This range of sentiment from bearish to modest optimism may be largely attributed to many of the issues we discussed so far. Will the Fed cut rates or keep them higher for longer? Will we have a recession? Will be the hope for soft landing, or will the economic landing be harder? Will corporate profits grow in the current valuations? Will inflation continue to decline? Many of these are binary events. For instance, the Fed will cut rates or it won't. This set of binary possibilities has resulted in much uncertainty as we head into 2024. And that uncertainty is shared by market experts from the most prominent firms. Of course, no one knows exactly what equities will do in 2024, and predictions at this stage are just that, predictions. We've covered a lot of information, focusing most of our discussion on what drove the market and what we expect to move the market over a short period of time. I want to end our investment discussion with a word on importance of investment discipline, or sticking with your investment strategy. And I'm going to go off path a little bit with a couple of slides after this because I want to talk about something specific. The potential of stocks to help build wealth for the long term may be challenging when investors move in and out of the financial markets. If we look at this image, we see a direct correlation to the probability of having positive gains in stocks with the time such investments are held. So for instance, over the last 94 years, 73% of all one-year periods had positive returns. However, if we travel out to longer holding periods, we see the likelihood of investment success rise to 84% for 3-year periods, and 88% for 5-year periods, and 94% for 10-year holding periods. In this illustration, stocks are represented by the S&P 500 Composite Index, an unmanaged index considered representative of the overall U.S. stock market. This is where I'm going to diverge a little bit because I want to talk about this because everybody's talking about it, right? The Magnificent Seven. Because I'm sure you've heard it a million times in your news feed. This chart shows here, it's actually the Russell 3000. It's not the S&P 500, but the Russell 3000, which is a little bit, it's 3,000 large cap, not 500. But you can see here that the Magnificent Seven, Tesla, Meta, Alphabet, Amazon, NVIDIA, Apple, Microsoft, those are the individual component returns to the Russell 3000 index return for the year. It's massive. So if you added those 7 blue lines up, that would account for the bulk of the return of the Russell 1000 for the year. So this chart shows how those market capitalization of those 7 stocks, how heavy they are represented. If you look at, this is the MSCI All World Country Index. You look at the Magnificent Seven, you see them, Apple, Microsoft. The weight of the Magnificent Seven is 16.9% of the MSCI, which is almost as big as the next 5 non-US country weights combined, which is 17.5. So 7 companies are valued almost the same as 5 countries, right? And you can see there in the US, obviously, we have the biggest weighting in the MSCI at 62%. And of that 62%, 16.9 is these 7 companies. And so when you're looking at an index, whether it's the MSCI or the S&P 500, you have to remember you're looking at an index. And the normal S&P 500 index is a market capitalization weighted index. So when you're looking at your returns and you look at the index and you're going, whoa, where's this divergence coming from? It's because in a weighted index like the S&P 500, you're really talking about 7 stocks. That's really when you're looking at that return, you're mostly talking about those 7 stocks. Look at this. So we take the same thing in the U.S. market, right? The U.S. market delivered 26%, and this is, again, the MSCI U.S. market, and then that's the same one on the right, which is the ex-U.S. global market. If you eliminated those top 7, the return on the U.S. market was 15.7% without those top 7 contributors, right? And you look at the comparison with the ex-US. If you eliminate the top 7 market cap weighted companies in the rest of the world, it only dropped by 1% or so. So these 7 companies, they have a huge impact on the return of the index. So when you talk about the index or you're buying the S&P 500 index, you're basically betting on these 7 companies. So we have the big question to ask ourselves, are those 7 companies, how are they priced? Are they priced to perfection? What happens if they have a slight miss in sales and a slight miss in earnings? What happens, right? It can really drive the index down. So we have to be mindful when we talk about indexes and our portfolios, because in portfolio management, what we're really interested in is risk management, in safety. And how we do that is we broaden out our portfolio. We don't narrow it to the Magnificent Seven, we broaden it out. But by broadening it out, you can see here, you're obviously compromising your potential return, but you're also lowering your risk. And that's really important to understand. Here's another key fact. A lot of people don't tell you about this one, okay? This is an interesting chart here. This chart shows the annualized returns in excess of market for stocks after joining the list of the 10 largest stocks, meaning what was the excess return of 10 largest stocks over time from 1927 to 2022. How did they do before they entered the top 10 and after? And if you look at it, you can see in the beginning years prior to going to the top 10 is where you had all the growth, which means these were probably either mid-cap companies or maybe large cap, but on the smaller side, that were growing quickly prior to entering the top 10 and becoming one of the top 10 market capitalization stocks. But then if you look at the start of the year in the top 10, that you look when they entered the top 10, how did they do after in their excess returns? They underperformed. Look at the 3 year. Well, in the first 3 years, it was 0.8. Then 5 years after, they were underperforming, and then 10 years they were underperforming. Why would that be? Why would these companies go and they enter the top 10 market capitalization and then they just start flagging? Well, because part of it is hype, right? People get excited about these companies. There's this momentum there, and investors get excited, and that's what a lot of retail investors are piling into the Magnificent Seven. Why? Because they can never do wrong, right? That's in their mind. They can never do wrong. Remember in 2000, I know a lot of you were around in 2000. Who were the big names in 2000? Cisco, Intel, AMD, right? HP, right? All these networking and computing companies, right? A lot of them have disappeared. They were merged or bought out. But most of these are no longer the strong performers and no longer carry that huge market capitalization as they once did in 2000. And so it's important that we don't get fixated on just these large companies that are doing really, really well. Now, I will tell you, in our portfolios, you do have exposure to the Magnificent Seven. They're there, but they're there along with a broad array of other stock investments to reduce the risk and lower the volatility. Because over time, we see there's a propensity for these big momentum, large capitalization stocks to underperform over time. And so, rather than trying to market time and pick which stocks are going to be the big growers and which ones are likely to flag, the proper approach is to do diversification through a broader array of exposures. Okay. So having said that, I'm going to move on to a closeout before we go into questions. Obviously, what we ask of you as our clients is we always want to be kept informed of important life changes and things like that. And if you have concerns specifically, feel free to reach out to us, book meetings, email us if you have a specific question you want answered, or call us. We're here for you. We're here to answer those questions. And finally, always make sure that your documents, especially your state documents and things like that, are up to date. It's mission critical. Glenn and I have seen it all the time where we have clients that, something happens and There's important documents that need to be in place to make sure that there is a measure of control and a measure of harmony in an estate situation. And what we're going to do and continue to do for you, we're going to keep you informed through regular communications. All of you are getting our regular updates. We'll spice that up with some emails when we think there's pertinent things to be addressed, or maybe a video. And of course, our state of the markets meetings. We're managing your investments according to your strategy. Everybody has a personalized strategy. No two clients are exactly the same. So we do a lot of customization of our portfolios for our clients. We continue to do that. We're continue to work in your best interest to make sure that we can give you the returns that your financial plan needs at the most optimized risk level possible. And finally, we're going to keep you abreast of these economic factors that we've discussed today, and we make our adjustments accordingly. I may have said this back in August, or maybe I didn't, but in our late third quarter last year, in our fixed income side of our portfolios, we moved from being short term on the fixed income side, where we were for many years while interest rates were very low. And we made a tactical decision to move out on duration when the 10-year hit, it was 4% plus. And that's turned out to be a really good move because in fact, interest rates really haven't gone higher. We didn't expect them to. And now in our fixed income part of the portfolio, we're able to clip these higher coupon rates, which is beneficial for our clients overall. So that's an example of how we adjust accordingly.
So the highest prediction by the experts, for the S&P 500 in 2024 was 5,100. And then the rest were either that or below. And as of today, we've hit 5,090, which is pretty much right there at that 5,100 mark. What comments do you have on that, having already hit the forecast in February?
Well, that's a good question. I mean, and that's the argument some make that stocks are getting ahead of themselves. And, and we will have periods of like advancing valuations and then some retreats, and what we call on the stock market parlance is like consolidating, right? Consolidating gains. I will say that the experts missed it by such a wide margin last year. They were mostly flat for the year, and they missed it completely. So it wouldn't surprise me if they miss by a wide margin this year. I think, though, that markets have had a good run. We saw a few good in the first couple of weeks of the year. We saw a really good run up, and stocks got ahead of themselves, and we saw some consolidation. But I think that we could expect periods of consolidation, and even right now, I think we could expect it, even though markets have been going up. But I also think that the economy is more resilient than people are thinking. I mean, that there's just not. We're not in the danger zone in terms of debt, household debt. We're not in the danger zone. It seems like we're pulling out of that earnings recession, and things seem really robust. So I'm thinking that, at the very minimum, we're going to end on the high side of that prediction. Now, I know there's still a lot of people out there saying recession has to come, but
saying that for 3 years.
They've been saying it for 3 years. A broken clock's right twice a day, but the problem is, we have to be invested, right? There's dividends to be earned, there's interest to be earned, and yes, we could see volatility in some pricing, but I think that the environment overall is more benign. So I'm not too cautious at this point.
That's great. I just have like one comment. The word resilient kept on coming up today. And, Daniel, as our lead portfolio construction analyst, you have created resilient portfolios.
Yeah.
And maybe you can elaborate a little bit on how you've constructed the portfolios, and also the change, that you made in the bond focus over the summer last year.
Yeah, I think I touched upon that right at the end. So when you look at resilience, a resilient portfolio is one that has a spread of different investments, what we call asset allocation, that are somewhat non-correlated or have low correlation. It's this correlation between assets that we're looking to diversify. Historically, stocks and bonds, bonds would move inversely to where stocks move. as people got out of stocks, they'd move into bonds for safety. And so there was either a low or a negative correlation between the two. And having that negative correlation allows you to optimize your return relative to the risks that you're taking. Now, 2022 was an exception because with the interest rate rise, all assets got clobbered. But we're starting to see that relationship normalize. And one of the beauties of the higher interest rates that we saw is those interest rates are now much more attractive. And so going forward, if we do see pullbacks in market, or even if we see a little bit of bearish sentiment and people are selling stocks, I think what you're going to see is people going into those bonds, but not just short term, also into longer term bonds. And so last year in the third quarter, when we made that tactical shift to move into longer duration or longer dated fixed income securities, it was a way for us to be more defensive and at the same time get better interest rates. And so even though the short end of the curve right now is pretty high, the short-term yields, I don't think those are going to be sustainable, especially if we see the economy slow down and the Fed starts cutting rates. You're going to see those short end interest rates drop pretty quickly, and you're going to also see the longer end probably drop a bit as well. But that's great for us because we're holding those bonds and we're going to see some capital appreciation in those bonds. Even if stocks are going down, we'll see capital appreciation in the bond part of our portfolio. That's how we optimize the risk and maintain our return. The other thing I will add is that for a lot of our portfolios, a lot of our clients, when appropriate, we've gone into alternative assets, largely private credit. Private credit has a great role to play in terms of providing very good yield and also being somewhat immune to the vagaries of the bond market. And so that's another way we've been able to enhance return in our clients' portfolio on a relatively lower risk side of the capital structure by being in private loans and also reducing volatility in the portfolio. So that's how we've managed our portfolios up until now. And a lot of the clients that we have, we've talked about this obviously one-on-one, but the bigger thing is asset allocation amongst stocks, bonds, and alternatives on a high level. On a more granular level within the stock market side, obviously we want to be exposed to the bigger stocks. We do tend to lean towards technology, both in terms of tech being a bigger part of the general indexes, but also in terms of our thematic growth. We're looking at very specific parts of the equity markets that we feel are going to give us long-term growth based upon very clear, distinct macroeconomic trends. Electrification, battery development, obviously electric vehicles, automation, and robotics, and artificial intelligence. All those are areas that we're looking for very specific exposure to for a long-term portfolio, for long-term growth of that portfolio, because we believe, we have high conviction that over a 10, 15, 20-year period, these sectors of the economy are going to grow the fastest. And so we want to have that exposure to that. I think that's probably, I think it's a good place to stop on that. But if anybody wants more specific discussions about their specific exposure, that's obviously best for a one-on-one. We're happy to schedule a meeting to talk to people about that.
Hey, Daniel, I have a question. Most of the leading economic indicators seem to be relatively positive over the last year or few months. And yet consumer sentiment about the economy seems to be very negative. You did mention that prices being up pre-COVID, but I wonder, are there other factors playing into that consumer negativity?
I think the single largest explanation is because, and I briefly mentioned that in my presentation, but if you really look at the data, it's because groceries are 30 to 40% more than they were pre-COVID. And so despite the relative strength of the economy and the job market, and it's easy to get a job, and wages have been going up. And in fact, wages are going up faster than inflation now. Despite all of that, people are still thinking, hey, that In-N-Out burger costs, it costs a few dollars more than it did before. So the world is not in a good place. And another factor, it's not exactly pricing, but you look at mortgages and housing affordability. They've got in their head that a 3% mortgage is normal, and that's just not normal. The long-term average mortgage rate is about 7.7%. And so to some extent, they're even lower than they are in the long-term average. But people have it in their head that, oh, they're paying too much. Well, and part of the reason is because housing prices tend to be sticky and they haven't really come down to meet the mortgages. So I think that's another big area of pessimism. So it's like your grocery prices and your rental costs, right? Your cost of housing. Those two things, I think, are what are keeping consumer sentiment fairly negative, despite the positives of the overall economy.
You see that changing sometime in the current year, that maybe the consumers are going to come around to a better understanding of how this works?
I think time will do some help in helping people understand what's normal. And I do think so. Rental prices are dropping in most major metropolitan areas. Even though there was a little article that came out today that the Bureau of Statistics, who does the Consumer Price Expenditure Index, the CPE, not the CPI, but the other one, they changed their mode for rents. And so it's thwarting the adjustment, because we really should be seeing, and we will be seeing, rental costs drop. And that's 30% of the inflation component is housing costs. And so when that comes down, we're going to start seeing that part come down. If you take out those housing costs, inflation is around the 2%, what the Fed is looking at, but this stubborn part of the market. Also, you're not seeing cost of housing, like in terms of housing prices, they're not really going up. They're not going down, but not going up. So if they stay flat, it may take 1 or 2 years at being flat for the cost of ownership to normalize. And I think that eventually that's what's going to happen. I definitely don't think we're in an environment where housing has got some big legs underneath it, where it's going to, your home price is going to go up that much. So if you're counting on your home equity being your ATM, that could be risky. So I think that's going to take a little bit of time. But those are really good questions. But I think that would be the two answers the two parts that I think are the basis for that negativity.
Thank you.
Mm-hmm. Any other questions? Okay, if not, I am going to call an end to this webinar. And as usual, we will send this out in a recording. And anybody who hears the recording can also schedule a meeting if they want to have a one-on-one and discuss their portfolio. Thanks for coming, everybody.